a lot about financial planning on this show. We talk about income, we talk about expenses, we talk about savings rates, we talk about investment returns, we talk about all the things. One aspect we don't talk a lot about is the mortgage. And if you think about, your personal balance sheet, there's assets and liabilities. Mortgage is often thought of as a big liability. Turns out it could have other uses too, as you think about your financial plan. Our guest is Alana Riley. She is head of mortgage insurance at banking at IG Wealth Management, and she joins us now from Calgary, Alberta. Hello there.
Hello, Bruce. It's great to be here with you today.
It is our pleasure to have you here. Make your case here. Why do mortgages belong in the financial plan?
Yeah, well, I think you hit the nail on the head right from the get-go in terms of, look, home ownership is, first of all, more complicated than ever. Home prices have obviously grown exponentially over the past number of years. Obviously, interest rates are something that we're all talking about at the kitchen table and on opportunities like this. And I think in the past, mortgages were left in, I would say, very siloed. They would just be off over to the side, potentially either going into your bank branch and dealing with it, potentially into mortgage brokers, but really not in conjunction with your overall financial plan. And it was really interesting. We did a mortgage study late last year. And no surprise, we found that the majority of Canadians believe home ownership is the most important part of the financial plan. 78% found, hey, this is an important part. However, only 1/3 of them actually said that their financial advisor had provided any type of great deal of advice as to how it would fit into this overall financial plan. And so, I think further to that, only about 20% said that they're knowledgeable about how insurance might fit in as part of this insurance of the plan. And then less than half believe how it's going to impact your overall financial wellness and potentially their estate in the future, their estate in the future. So, like, I think it's just becoming a bigger and bigger piece of the financial planning process, particularly as the payments to these mortgage payments continue to increase.
So give us some examples here in terms of how it fits, the kinds of conversations that your financial planner should be having with you as it relates to the mortgage. And then separately, we'll get to kind of what you can do about it. But first of all, how does it fit?
Yeah, for sure. Great question. Because, oftentimes right now, particularly in this rate sensitive environment, you hear clients and sometimes advisors, well, what's your best rate? What's your best rate? Well, it's hard to say what's the best rate when we don't know anything about your life goals, what you want to do, where this fits. And I call it the let's help you sleep at night plan. Are you a client that is going to be losing sleep because you're in a variable rate mortgage and you don't know what that next payment is going to be? We're on the eve here of finding out what's going to be happening on the next rate announcement. And so for some individuals who have that variable, they're comfortable with that. They understand that the long-term gain of that and they want to have that. Others not so much. Some people might want to sell their house in 2 years. Others want to stay in 5. Do they know the pre-penalty payments or the early penalty payments for getting out when they've decided they want to move? Do you want to help multi-generation? We're seeing a lot of multi-generational family planning happening. So primarily, can we use your primary property because we want to either help with a family cottage or help next gen get into their first home. So there's a lot of complicated pieces now, and let alone other tax opportunities that there is in terms of some savings that really take a certified financial planner in conjunction with a mortgage specialist to really help Canadians guide them through this complex journey.
One of the pieces is the speed with which one chooses to pay off a mortgage. And, some people have a tax refund or some other windfall, or they're sufficiently cash flow positive that they could pay off that mortgage a little bit faster. But one of the calculations that a great planner is going to do is to demonstrate how the different scenarios would play out over time based on certain assumptions. Talk a bit about how the planner is going to determine where that incremental dollar should go. Should it go to a lump sum on the mortgage? Should it go to maxing out an RRSP in a low cost investment vehicle that's going to grow at 6 or 7% over time?
Yeah, great. Again, another great question. And it all goes back to this is really individual, personalized questions that are part of your financial plan. So to give you a few examples is it depends on whether debt you're carrying. If you're carrying credit card interest at 18 to 22%, Well, guess what? It makes a lot more sense to pay that down a lot faster. Even if you're carrying a mortgage at a new rate of 529, all of that is a lot cheaper borrowing than you'd be paying, on an interest rate on unsecured debt. So, that would be a part of it. Also, first of all, how does this fit into some of the other goals that you might have? And so I think that working with a financial planner, you can actually achieve a number of these strategies simultaneously, right? And so it starts off by looking at what is your overall cash flow? Is it more important to put towards your RSP because potentially maybe you don't have the benefit of having a pension or other savings vehicles? So maybe that's taking the priority over the longer term approach to the mortgage. And it's interesting. I think that there's this thought process by some that, high net worth Canadians don't need mortgages. And I always say that's the complete opposite. High net worth Canadians know they know how to use credit very wisely, but they use it to work towards their advantage. And so you can do that and use credit in unique and different ways towards your advantage, and still meet some of those other goals in terms of longer term planning. So all of that to be said, this is why you don't want to do the mortgage in isolation for the rest of your financial plan.
One of the other dynamics when we talk about credit is a home equity line of credit. So there's the mortgage, which has a relatively predictable payment, even if it's variable, it's within a band. But then there is the opportunity to take out a line of credit that's secured by that equity. Lots of pros, gives you some insurance if you need cash. You can use that money for other things. But what are some of the downsides that a great financial planner is going to flag on the HELOC? Because when people talk about that, I have questions, given my concern about how it can sometimes mask cash flow issues or enable poor behavior.
Yeah, so look, the good news is for us at IG Wealth Management, working with financial planners, we feel that we have clients that are well on track to achieving their financial goals and providing a great, solid future for their families to come. And so I think that there's a bunch of questions that were built in there. One, you mentioned tools that we use to really help. And we do have a great tool right now. It's really interesting because no surprise, Bruce, I've heard some of your other great podcasts already on this topic. Some are really looking at, even the one that you had last week around, what does my overall banking strategy look like? Do I do my annual health check? It was one of the conversations you had recently, and that's no different from what you should be doing if you have a HELOC. This is not a one and done. I'm going to sign up for a HELOC. I'm going to pay the interest only. I'm never going to pay it down. That is not the right strategy if this is what you're setting up the HELOC for. So I would agree with you there. What I would also say is, for many of our clients, when the perfect time to apply for credit is not when you need it, right? So you want to be able to have the freedom and flexibility that you mentioned, that you have this line of credit available to you should you need it, should there be some type of emergency, should you decide that, hey, you know what, guess what? We just went away on a vacation and we're so excited. We're actually decided that we're going to buy a place in Florida or wherever our clients are going. But you know what? For many right now might not be the time that they want to take it out of their investment portfolio. There might be an opportunity to use your primary residence to get that secondary property to buy, other investments. And then later, depending on when the market, changes, then there might be a time that they're wanting to pay it down more aggressively. So I think there's all different types of ways that you can use a HELOC and use it effectively. And the tool that I was mentioning that our team uses is really around looking at comparatively, if you took out a 5-year or you took out the HELOC, many are, battling between what product, what term should they take right now, with some great anticipation that rates are going to be back to 199 or 299 in the near future. And so we can really map that out so that you can really understand the what ifs and really understand how that would impact the financial plan in the future.
They are going to be so disappointed if they are so optimistic about such a big rate decline. Do you send them like chocolates when they don't get what they want on that front?
Yeah. You know what? Look, we have a whole generation of borrowers that are used to being in a 299 or 349 or 199 environment. And, as we say, there is a lot of sticker shock going on right now in terms of, call it the new norm. So any of us who've, been around for a longer period of time quite remember these days, and that's still not that bad, I guess, in comparison to, the decade beforehand. That's for sure. But yeah, there's still a lot of sticker shock indeed, Bruce.
You make a great case for thinking holistically about that financial plan and including the mortgage. And we thank you for joining us to talk about it today, Alana.
Thanks so much for your time, Bruce. My pleasure.
Alana Riley, the head of mortgage insurance at banking at IG Wealth Management. She joined us to talk about the importance of including thinking around your mortgage in your financial plan.